I'm here with the amazing Vice President Apollo Lupescu from Dimensional Fund Advisors, otherwise known as the Director of Explaining Stuff. I think it's Director. Is that?
I don't know. It's something like that. Whoever came up with that. It's like...
And let's turn it over to Apollo and hear some of his thoughts about this most recent third quarter of 2020.
Right now, in the U.S. market, the way that I think Mark and I share that philosophy, we look at this the stock market in the U.S. as being about 3,511 companies that have opened up their ownership to the public at large, and these are called tradable stocks. So whether you look at Nasdaq, New York Stock Exchange, American Track, there are all these different, there are about 14 different exchanges or so that you can buy these stocks. That's what the stock market is to us. It's this comprehensive look at all the stocks that can be bought and sold.
Yeah.
Now, every company has a bigger or smaller economic impact. Has meaning. In other words, they're larger or smaller. And what we consider large is the world called capitalization. And what it means is that when you look at the value of all the shares of ownership and how much each one of them cost, you get a sense of how much would you need to pay to buy the entire company. That's the overall value. If you pay that, you would get the entire company. So you have to know the number of shares and how much each share is worth it. And the companies that have a larger value, they tend to represent a greater percentage of this overall market. So not all companies are equally weighted. So some companies, the larger ones, would have a greater percentage allocation to them. And in this case, the largest stocks in the US, we all know these companies. Apple, it's close to $2 trillion. You had Microsoft, Amazon, Google, and Facebook. When you look at combined, the five of them, those are the largest stocks in the U.S., and they do represent a larger percentage than other companies that might be in this 3,500 or so stocks. The smaller they are, the smaller the percentage. So it's kind of like, what's the economic, how meaningful from an economic perspective is that company? And that's what you're trying to reflect. So it's not just that you have 3,000 of them, but how much emphasis do you put into one of them? This type of constructing a market is called a capitalization index, a market cap index, which means that the market capitalization, the value of each company, is reflected in the percentage that you see out there in the market relative to other companies.
Right.
That's what market is to us.
Yep.
Now, when you turn on the radio, when you look on TV, when you on the internet, the probably the most widely used metric is the Dow Jones Industrial. Dow Jones, everybody knows Dow Jones, and that's how often we cite how the market, not we cite, but talking about in general, the public, how any investors might discuss how the market do by reflecting on what they heard on the news about the Dow. So what is the Dow? It's the longest running way of measuring the market, going back to the 1880s, when Charles Dow established it. Initially, it had 12 different companies, but today it has 30 companies. So the Dow Jones has 30 companies out of the 3,000 that exist in the U.S. market. So certainly, it's a pretty low number of stocks. And together, the value of these companies amount to about 26% of the value of all stocks in the market. So what's interesting is that, think about that measure. It's pretty shallow. We're looking at 30 companies to reflect on how 3,000 plus did. And the value of these companies is about a quarter of the value of all stocks in the market. So certainly not a very broad measure. It's a shallow measure. It is the oldest, and probably that's why it's still being used, but professionals don't really use it because it is so shallow. Not only that, but the Dow has one more thing that makes it a fairly inefficient way to look at the market. What the Dow is looking at is not the value of the company as a whole, but rather what is the value of each share? What's the price of each share? And to really understand the difference, think about this. You can have a very large pizza pie that you cut into a large number of slices, where you can have a much smaller pizza pie that's only cut in two. Well, what matters more, the size of the pizza pie as a whole, or the size of each slice? It turns out that the companies themselves decide how small do I want to cut the slice. So the price per share is almost insignificant. A few weeks ago, Apple had an event where they basically said, we're going to cut our slice into smaller pieces. It didn't change the value of the size of the pie. It just simply had more slices. Well, at that point, the Dow Jones actually cut its percentage way down. And Apple, what used to be towards the top, it's no longer towards the top. So what are the biggest holdings in the Dow that are supposed to represent the US market? The largest one, United Health Group. We all know United Health, but it's not like you don't go out there and say every day I run into United Health. The Home Depot, certainly known, Microsoft, McDonald's, and Visa. What's interesting is that Amazon, Facebook, and Google, Alphabet, they are not part of the Dow. And Apple is in the bottom half after they cut their slices into smaller pieces. Yeah. So how can we possibly consider a metric of how the market did without having 3 out of the 5 largest companies as part of that metric, and the largest one being somewhere down to the bottom? It's a very shallow metric, and yet it resisted. I mean, a lot of people still reflect on the Dow and how the market did when it is not the best way to look at it. And I think it's important. Most people, I find, they don't really realize the limitations of the way the Dow measures the market. So that's the most popular way. Now, Mark, not that you do, but when typically people look on the news after the Dow, what's the next one that everybody looks at?
It's Nasdaq.
Nasdaq, exactly right. Nasdaq. What is Nasdaq? Nasdaq is a way of looking at all the stocks that have chosen to trade on that exchange. You can trade to whatever exchange you want, but these companies have chosen to trade there. And right now, in that particular way of looking at the market, there are about 2,000 stocks, so certainly a lot more than in the Dow. The thing is that some of them are US, some of them are international. But what's also interesting is that a lot of the large companies that are in the US market chose not to trade on NASDAQ, but they might trade in New York Stock Exchange or some other one. And because they're not listed on NASDAQ, they are not part of this group of stocks. And because of that, NASDAQ represents less than half of the value of all companies in the US. So it has a large number, but so many out there, tiny ones, the small companies that don't amount to much. And that's why NASDAQ is only about half. Now, NASDAQ, similar to what we talked earlier, it is a market cap based index. So the value of the company as a whole, the value of the size of the pizza pie matters the most. And in that respect, you do see these largest companies as being on top because they all actually trade on NASDAQ. But what's fascinating is to see how concentrated the NASDAQ index is. When you look at NASDAQ, 41% of the value of NASDAQ comes from 5 companies. 5 stocks amount to 41%, which is a remarkable concentration in just a handful of stocks. Is NASDAQ representing the market? Yes, Mark.
And it's even worse because a lot of people buy that NASDAQ 100 to get NASDAQ exposure. And now instead of 2,763 stocks, you got 100. And you probably don't have the data here, but this 41% might go to what? I don't know, 60 something?
Whatever. I won't even speculate, but you get the picture.
It
you only have 100.
Higher.
Yeah. Right.
The other thing, there are a couple, before you get to your next one, I just wanted to reflect on a couple things. It wasn't too long ago, maybe 10, 15 years ago, that we had 5,000 stocks instead of 3,500. It was where the Wilshire 5,000 name came from.
Right.
Now this is more reflective of the Russell 3000. We're getting closer to that. But it is interesting to note that we've had, 1,500 stocks or so that have basically gone away through either delisting, mergers, or just failure of the companies, whatever it might be. And so we do have a little more concentration in our US markets. The final point I want to make is we do have a lot of clients who call us and say, I really love that Apple stock. I'd like to buy some Apple. And I tell them, you have Apple. It's 5% of your US large cap holding. Why would you buy more? Why would you overweight Apple beyond the allocation, that we've carefully constructed for you? And in fact, I like to tell people I love all stocks. We have 13,000 of them across the board. And so, you don't need to really pick one that you think is maybe mispriced or underpriced. Anyway. So those are a couple observations. So I didn't see the S&P 500 in there.
Right, it's coming up. It's coming up, but that's a great point. That's a great point that he made. And we'll come back to this because perhaps we should touch on this. If Apple has done so well and you know the company, use the products, why not invest more in it? Because I think that some people are saying, I know we had it, but why didn't we have more of it? And perhaps it's worth addressing it. So let's talk about the third one, the third leg of the stool, which is, the third way to consider, not leg of the stool, but the third way to consider the market, which is what professionals tend to use. And I know that Mark and I quite often you see it on our websites. It's the S&P 500. And in this case, the stock exchange on which the company trades is irrelevant. So in that case, it's more comprehensive because these are largest 500 companies, and it does amount to about 84% of the value of all stocks. And even though it doesn't have as many as Nasdaq, it only says 500 because it includes a lot of the large stocks that are not part of Nasdaq. They trade on New York Stock Exchange or others. It is more comprehensive. So that's why you see that you have more coverage of the market through the S&P. Now, they tend to be only the large companies, the largest 500 companies, but also to make it clear, not all of them. S&P is a pretty tricky little thing because there's a committee making decisions on what companies to go in there. And just because a company is large, it doesn't mean that it's included. And I think the shining example of that right now is Tesla. As large as Tesla is not part of the S&P. The S&P committee has decided not to add it in, even though the criteria has been met. They just chose twice so far to just say, no, we don't want Tesla there. Now, for Nasdaq, Tesla is actually the sixth largest, if I remember correctly, holding, and Tesla has done remarkably well. So it is in Nasdaq, but it's not in the S&P. So it adds even more confusion, and certainly not in the Dow. But to me, it's a really important thing. And by the way, the same as the market and Nasdaq, the S&P is a market cap-based index when they do consider the size of the company and the way they weight each stock. And in this case, when you look at the largest 5 companies, they amount to about 24%, which even in the S&P, it is quite a bit. In the overall market, it's less. It's about 19%, but in the S&P is even more. So that's how we consider the market. So what is the market? I would argue that the way that Mark looks at it, the way that we're looking at it, is a much more representative way of saying, well, how did the market do? But it also comes with one other thing. This is not the market, because when we think about the market, this is the U.S., which is a big part of the global opportunity set, but there are certainly companies and countries abroad in which you can participate as an investor. And when you really put it in a global perspective, what you see is that from a global perspective, instead of 5,000 or 3,000 stocks, you have over 14,000 different companies, US and global, in which you can invest. And that is a true global opportunity set. That is a true global opportunity set. And from that perspective, if you are invested and diversified globally, then certainly it makes it harder for you to compare yourself with a little subset of the Dow Jones, which is only 15% of the value. How can you take 30 companies in the Dow and say, well, how did my portfolio do, and compare with the 14,000 that you had? That's really important to know, that there will be differences. You do have the Dow stocks, but they're part of a much broader perspective. You have the Nasdaq stocks, but they're part of a much broader perspective. And this is really important, particularly at this moment in time. And let me tell you why this is so important at this moment in time. It is important because if you look through the end of September, so not for the quarter, but year to date, the S&P 500, the U.S. market, has done actually quite well given the pandemic and everything else that's going on in the world. And you might look and say, that's great. That's fantastic. That's so good to hear. Now, let's break it down a little bit. When you look at the S&P 500, the largest 5 companies, the Apple, Amazon, Microsoft, Alphabet, and Facebook, on average, through that first 9 months of the year, they had a whopping 40% return. That's why people are paying attention to these companies, because through this year, because of a variety of reasons, they are up 40%. Is that unreasonable? Well, you know what? It's not like we don't know who these companies are and we don't use them every single day. I mean, I know there's a box coming every day. I don't know who's buying in my house and why is it, but I know it's coming sometimes twice a day. I mean, there are Amazon trucks going up and down the street every day. We all use Apple products and Microsoft. We're using it right now. Google. So we do know that these companies are making money and they're being used more and more. So they have done tremendously well. Now, what about the rest of the 495 different companies that are in the S&P? Well, when you average them out, what you see is that on average, the rest of them lost about 5% for the year. So in other words, it's a story it's a tale of 2 groups of companies. The large 5 stocks have crushed it. They've done tremendously well, and that's phenomenal, but not necessarily the rest of the market. And why is that relevant for the discussion at hand? Because if you look at this global perspective that we had on stocks, so and you look at these companies, the 5 stocks and Tesla, they have done tremendously well, and they are 41% of Nasdaq. So if you put so much money you happen to have put so much money into these 5 stocks that have done tremendously well, this guy here is going to look like a superstar. Nasdaq is going to look like a superstar because they were so concentrated into these 5 stocks. The next one probably will be, if you look at performance, is likely to be, so if this is the top, if this is one, probably the second one would be the S&P because it has a quarter of the money in those stocks. The third one among the popular ones is probably going to be Nasdaq, Dow Jones, because it doesn't have 3 out of the 5, and the ones that does have them, like Apple, is towards the bottom half. So you can see that on the news, if you look every single day, there will be a discrepancy. There'll be a disparity between how the Dow, the S&P, and the Nasdaq do. And when these 5 tech companies do really well, Nasdaq shines. When they do poorly, it's going to tank. And that's what we're seeing, is that every day there is a different performance on the news. Pay attention, and you'll see that Nasdaq does one thing, the Dow did another thing, the S&P did another thing, because of the way they're constructed. And last but not least, to the point that Mark made earlier, you did not miss out on these 5 stocks. They were part of a global allocation. They were part of this global portfolio. It's just that because we're so diversified, they're only 11%. So if you're going to look and see how did the globally diversified portfolio do relative to NASDAQ, well, I know it's not going to do as well because it's not so concentrated in these 5 stocks that happen to have had a tremendous year. So it's a lot about managing expectations and realizing, why is my portfolio behaving differently? Not that you're missing out on anything. It's just that it's more diversified. And at this particular moment in time, you had these high flyers, but you also are diversified because one of the things that I'm going to come back over and over, you need to be diversified. You cannot capture the next Amazon by being invested only in Amazon. You need to go outside of these large stocks that have done so tremendously well.